In the previous video, we learned about exchange trade market, where all the transaction take place through the recognized stock market. So, but here we have a interesting question. What if two parties wanted to trade directly without using a stock exchange? Is that even possible? The answer is, of course, yes. And that's exactly what we call that over the counter market or simply the OTC market. Hello everyone, welcome back to the channel. Today we are going to discuss about that OTC market, how it works and why many businesses and financial institutions use it. Let's begin with a simple example. Imagine you want to buy a custom made dining table. Would you go to a supermarket? Probably not. Instead you should you would contact a carpenter directly. You would like to discuss the size, the design, the wood type, the price, and the delivery date. Everything is negotiable between you and the carpenter. The OTC market works in a very similar way. Instead of trading through a stock market with standardized contract, buyers and sellers negotiate directly with each other. This allows them to customize the contract according to their specific needs. So, what exactly the OTC market? An over-the-counter market is a decentralized financial market where securities and derivatives contracts are directly traded between two parties, usually with the help of dealers, brokers, or financial institutions. Unlike exchange trade market, there is no centralized exchange controlling every transaction. Now let's understand how it works. Suppose an airlines industry is worried that fuel price may increase over the next 6 months. The company approaches a bank. Both parties discuss their requirement and agree on a customized contract that help protect the airline from rising fuel price. The contract is designed specifically for that particular airline. No stock exchanges involved. This is an example for a OTC transaction. One of the biggest advantage of the OTC market is flexibility. The party can decide almost everything: the contract amount, the price, the expiry date, and even the terms and conditions. This mark makes OTC contract highly suitable for business with unique financial need. However, great flexibility also comes with greater risk. Since there is no exchange acting as a guarantor, there is a possibility that one party may fail to fulfill the contract. This is known as counterparty risk. Another limitation is lower transparency. Unlike stock market where prices are visible to everyone, OTC transactions are private agreements. The terms and price are usually known only to the parties involved. Let's quickly compare with the exchange trade market and the OTC market. In the exchange trade market, contracts are standardized. Rules are already fixed. Prices are transparent and the exchange guarantee the transaction. In the OTC market, contracts are customized. The terms are negotiated directly. There is a greater flexibility but also higher counterparty risk. So which makes us better? The answer depends on the situation. If you want safety, transparency, and standardized, trading and trade through the exchange trade market in generally the better choice. But if you need contract designed specifically for a business or financial requirement, the OTC market offer much greater flexibility. Let's summarize today's lesson. The OTC is a decentralized market where business and seller trade directly. It offers customized contract and greater flexibility, but it also involves higher counterparty risk and less transparency than an exchange trade market. Now that you understand both market, you will find it much easier to learn topics like forwards, futures, options, and swaps. Because these derivative contracts are traded either on exchanges or in the OTC market. Thank you for watching this.